Chapter 21, Cost Volume Profit Analysis. Managers need to know how a business's costs are affected by changes in its volume of activity, such as number of products produced and sold, in order to make good decisions about business. Let's look at three different types of costs. You have variable costs, fixed costs, and mixed costs. Variable costs are costs that increase or decrease in total in direct proportion to increases or decreases in the volume of activity. Volume is the measure or degree of an activity of a business action that affects cost. In other words, the more volume, the more cost is incurred. Using Smart Touch Learning as an example, the direct materials that are used to make the tablets are a variable cost. For example, each tablet requires one battery at a cost of $55 per battery. This chart shows the cost for batteries at various levels of activity. As you can see, the total variable cost of batteries increases proportionately as the number of tablets produced increases, but the battery cost per tablet does not change. Exhibit 21.1 graphs total variable cost for batteries as the number of tablets produced increases from 0 up to 100. If Smart Touch Learning does not produce any tablets, it incurs no battery cost. Therefore, the total variable cost line begins at the bottom left corner. This point is called the origin, and it represents 0 volume and 0 cost. The slope of the variable cost line is the change in battery costs on the vertical axis divided by the change in the number of tablets produced on the horizontal axis. The slope of the graph equals the variable cost per unit. In this case, the slope of the variable cost line is $55 per tablet. The graph in Exhibit 21.1 shows how the total variable cost of batteries varies directly with the number of tablets produced. But again, note that the price per tablet remains constant at $55. Direct materials such as batteries are a variable cost. Direct labor is also a variable cost. Manufacturing overhead usually includes both variable and fixed costs. Next, we will take a look at fixed costs. In contrast to variable costs, fixed costs are the costs that do not change in total over wide ranges of volume of activity. Some common fixed costs include rent, salaries, property taxes, and depreciation. Exhibit 21.2 graphs Smart Touch Learning's depreciation on the manufacturing plant and equipment. The company has these fixed costs regardless of the number of tablets produced. Smart Touch Learning incurs $12,000 of depreciation each month, and the number of monthly tablets produced is between 0 and 100. As we can see in Exhibit 21.2, fixed costs are graphed as a flat line that intersects the cost axis at $12,000 because Smart Touch Learning will incur the same $12,000 of fixed costs regardless of the number of tablets produced during the month. This chart shows the total fixed costs at various levels of activity. Note that total fixed cost does not change, but the fixed cost per tablet depends on the number of tablets produced. If Smart Touch Learning produces 25 tablets, the fixed cost per tablet is $480, which is found by taking the $12,000 total fixed cost and dividing it across the 25 tablets. If the number of tablets produced doubles and becomes 50 tablets, the fixed cost per tablet is cut in half to $240. This is the $12,000 total fixed cost divided by 50 tablets. Therefore, the fixed cost per tablet is inversely proportional to the number of tablets. In other words, as the number of tablets increases, the fixed cost per tablet decreases. Exhibit 21.3 provides a summary of the characteristics of variable compared to fixed costs. Costs that have both variable and fixed components are called mixed costs. For example, Smart Touch Learning's cell phone provider charges $100 per month to provide the service plus 10 cents for each minute of use. If the cell phone is used for 100 minutes, the company will bill Smart Touch Learning $110. That's $100 of fixed cost per month, plus the variable cost of 100 minutes at 10 cents per minute. The table shows the cost for the cell phone at different levels of activity. Exhibit 21.4 graphs Smart Touch Learning's cell phone costs. It can separate its cell phone bill into fixed and variable components. The $100 monthly charge is a fixed cost because it is the same no matter how many minutes the company uses the cell phone. The 10 cents per minute charge is a variable cost that increases in direct proportion to the number of minutes used. If Smart Touch Learning uses the phone for 100 minutes, its total variable cost is $10. 100 minutes times 10 cents per minute. If it doubles the use to 200 total minutes, total variable cost also doubles to $20. That's 200 minutes times 10 cents per minute. And the total bill rises to $120. The fixed cost of $100 plus the new variable cost of $20. When companies have mixed costs, it is helpful to separate the costs into their variable and fixed components so managers can use the information to make planning and control decisions. An easy method to separate mixed costs into variable and fixed components is the high-low method. This method requires you to identify the highest and lowest levels of activity over a period of time. To illustrate the high-low method, we will look at the maintenance costs for Smart Touch Learning's manufacturing equipment. Looking at the data for the year, we identify the quarter with the highest activity, the third quarter with 480 tablets, and the quarter with the lowest activity, the fourth quarter with 240 tablets. Step 1 of the high-low method is to identify the highest and lowest levels of activity and calculate the variable cost per unit. We've identified the high and low levels of activity. We now calculate the variable cost per unit by using this formula. The change in total cost is divided by the change in the volume of activity. In other words, the difference between the high and low costs is divided by the difference between the high and low volumes of activity. The result is a cost of $2 per tablet. Step 2 is to calculate the total fixed cost by subtracting the total variable cost from the total mixed cost. To do this, we must calculate the total variable cost as the variable cost per unit multiplied by the number of units. Here we use the high volume of 480 tablets and its total mixed cost of $1,960 in the formula. The result is a fixed cost of $1,000. Note that you can also use the lowest volume and its mixed cost in this formula to calculate the very same $1,000 total fixed costs. Step 3 is to create and use an equation to show the behavior of a mixed cost. The total fixed cost is equal to the total variable cost, which is variable cost per unit multiplied by the number of units plus the total fixed costs. In this case, the maintenance costs are equal to $2 per tablet multiplied by the number of tablets plus $1,000. We can then use this formula to predict the manufacturing equipment maintenance cost if 400 tablets are produced. When the volume activity is 400 tablets, we would expect the maintenance costs to be $1,800. The high-low method provides a rough estimate of fixed and variable costs that can be used for planning purposes. The high and low activity volumes become the relevant range, which is discussed in the next section. Managers find the high-low method to be quick and easy, but there are other more complex methods that provide better estimates. One of these methods is regression analysis, which can be completed using spreadsheet software such as Excel. This method is illustrated in more advanced accounting textbooks, such as cost accounting textbooks. The relevant range is the range of volume where total fixed costs remain constant and the variable cost per unit remains constant. To estimate costs, managers need to know the relevant range because total fixed costs can differ from one relevant range to another, and the variable cost per unit can differ in various relevant ranges. Exhibit 21.5 shows fixed cost for Smart Touch Learning over 3 different relevant ranges. If the company expects to produce 2,400 tablets next year, the relevant range is between 2,000 and 4,000 tablets, and managers will plan for fixed costs of $144,000. To produce more than 4,000 tablets, Smart Touch Learning will have to expand the company. This will increase total fixed costs for added rent, supervisor salaries, and equipment costs. Exhibit 21.5 shows that total fixed cost increases to $216,000 as the relevant range shifts to this higher band of volume. Conversely, if the company expects to produce fewer than 2,000 tablets, the company will budget only $72,000 of fixed costs. Managers will have to lay off employees or take other actions to cut fixed costs. Variable cost per unit can also change outside the relevant range. For example, Smart Touch Learning may get a quantity discount for batteries if it purchases more than 4,000 at a time. We also need to remember that costs are classified as fixed or variable relative to some activity. However, if the frame of reference shifts, then the classification can also shift. For example, Smart Touch Learning may lease cars for sales representatives to use when making sales calls. The amount of the lease is the same each month, $500. Therefore, relative to the number of tablets produced, the cost is fixed. Increasing or decreasing the number of tablets produced does not change the total amount of the lease. It remains constant at $500 per month. However, relative to the number of sales representatives, the cost is variable as it is directly proportional to the number of sales representatives. If there is one sales representative, the total cost is $500 per month. If there are 2 sales representatives, then 2 cars are required and the cost doubles to $1,000 per month. While the cost per unit remains constant, $500 per sales representative, the total cost changes with the change in volume, number of sales representatives. For all examples and problems in this textbook, when classifying cost as fixed or variable, classify as relative to the number of units produced and sold unless told to use some other classification specifically. So for this try it, the following is a list of costs for a furniture manufacturer that specializes in wood tables. You need to classify each cost as variable, fixed, or mixed relative to tables produced and sold. Part 1, or question 1, wood used to build tables. Obviously, as you build more and more tables, you need more and more wood. So that would be a pretty easy variable. Number 2, depreciation on saws and other manufacturing equipment. Well, this one, within the relevant range, assuming you don't have to expand the company to produce whatever you want to produce. You've already bought the equipment, and that's not going to change whether you produce 10 or 50 of these. So this is going to be a fixed cost. Compensation for sales representatives paid on a salary plus commission basis. Well, you've got the key right there in that last part of the sentence. You've got a fixed salary plus commission, which will vary depending on sales. So this is going to be a good example of a mix. Number 4, supervisor's salary. Well, supervisor's salary isn't going to change, assuming it's just a fixed salary, whether more or less is produced. Number 5, wages of production workers. Well, the number of hours worked is the direct labor cost to produce the product. So as you produce more product, you have more man hours of labor. So as an hourly worker, these are going to be variable costs. Next, we look at how managers can use cost behavior, variable, fixed, or mixed, to make decisions. Suppose Smart Touch Learning sells 200 tablets for $500 each that incur variable costs of $275 each. A useful figure for managers to compute is the contribution margin. Contribution margin is the difference between net sales revenue and variable costs. It is called contribution margin because it is the amount that contributes to covering the fixed costs and providing operating income. Net sales are $100,000, which is computed by multiplying $500, which is the selling price, by the 200 tablets. Total variable costs are $55,000, which is computed by multiplying $275 of variable cost times the number of tablets, 200. The result is a contribution margin of $45,000. So another way to think about this is the variable costs is a certain amount that you have to take out of every product, every one produced, because that's how much each one of those costs to produce. Okay, in addition, obviously, to the fixed cost. So you automatically have to suck out the amount of each tablet that's a variable cost, because no matter what, no matter how many you make, it's always going to cost you that much to produce one more. Okay, regardless of the equipment you have and all of that stuff. So if you know you have that amount of variable cost with each tablet, you subtract that off right away, and whatever's left over is the amount that will first go to pay for your fixed costs, and then after that will go towards profit or whatever else you need the money for. The previous example calculated contribution margin as a total amount. Contribution margin can also be expressed at the unit level as a unit amount. It is the difference between net sales revenue per unit and variable costs per unit. Note that the terms unit contribution margin and contribution margin per unit are used interchangeably. For Smart Touch Learning, the unit contribution margin is $225 per tablet. The third way to express contribution margin is as a ratio. Contribution margin ratio is the ratio of contribution margin to net sales revenue. In other words, it is calculated as contribution margin divided by net sales revenue. Because contribution margin is based on sales price and variable costs, which do not change per unit, the ratio can be calculated using either the total amounts or the unit amounts. As we can see from the Smart Touch Learning example, the contribution margin is calculated as 45% whether we use the total amounts or the per unit amount. A traditional income statement classifies costs by function. That is, costs are classified as either product costs or period costs. Remember that product costs are those costs that are incurred in the purchase or production of the product sold. For a manufacturing company such as Smart Touch Learning, the product costs are direct materials, direct labor, and manufacturing overhead. These costs accumulate in the inventory accounts until the product is sold. At that point, the costs are transferred to the expense account called cost of goods sold. The period costs are the selling and administrative costs. This is the format that is required by GAAP, the Generally Accepted Accounting Principles, and the format that you have been using thus far in your accounting studies. The traditional income statement format does not always provide enough information for managers, so another format is sometimes used. A contribution margin income statement classifies costs by behavior. That is, the costs are classified as either variable costs or fixed costs. For this, try it. A furniture manufacturer specializes in wood tables. The tables sell for $100 and incur $40 in variable costs. The company has $6,000 in fixed costs per month. For number 6, prepare a contribution margin income statement for 1 month if the company sells 200 tables. And then for number 7, what is the total contribution margin for the month when the company sells 200 tables? So we would have, for the contribution margin income statement, sales revenue first, which will be 200 tables times $100 per table. So that's $20,000. And then we'll have variable costs, or 200 times 40 per table, which is $8,000. And when we subtract that $8,000 from the $20,000, we're left with a $12,000 contribution margin, which is the same as 200 tables times $60 per table. We subtract out from that the fixed cost of $6,000 and to operating income of $6,000. So all we have to do to calculate the contribution margin is to look up on the contribution margin income statement what that amount is. And you can see here that that's $12,000. So let's try a couple more. The furniture manufacturer specializes in wood tables. The tables sell for $100 and incur $40 in variable costs. The company has $6,000 in fixed costs per month. What is the unit contribution margin, and what is the contribution margin ratio? For unit contribution margin, we've got $100 per table, which is the total revenue for the table, $40 in variable costs, so we've got 100 minus 40, and that leaves us with $60 per table that is considered the contribution. Now, what is the contribution margin ratio? Well, we just take the $60 per table, which is the contribution margin, and divide it by $100, which is the amount of revenue. So you see 60 divided by 100, and we're left with 60%. Now that you have learned about cost behavior, let's see how managers use this information to make business decisions. Cost volume profit, CVP, analysis is a planning tool that looks at the relationship among costs and volume and how they affect profits or losses. CVP is also sometimes referred to as cost volume price analysis because changes in sales prices also affect profits and losses. There are 5 assumptions that are made with cost volume profit analysis. First, the price per unit does not change as volume changes. For example, Smart Touch Learning assumes that all tablets will sell for $500 each. Second, managers can classify each cost as variable, fixed, or mixed. Another assumption is that the only factor that affects total costs is change in volume, which increases variable and mixed costs. For example, Smart Touch Learning assumes the variable cost per tablet is $275. Similarly, it is assumed that fixed costs do not change. In our example, Smart Touch Learning assumes fixed costs are $12,000 per month. Finally, there are no changes in inventory levels. Smart Touch Learning assumes the number of tablets produced equals the number of tablets sold. Most business conditions do not perfectly meet these general assumptions, so managers regard cost volume profit analysis as a rough approximation, not an exact figure. Cost volume profit analysis can be used to estimate the amount of sales needed to achieve a target profit. Target profit is management's profit goal. Required sales can be expressed as either a number of units or as a total dollar figure. We will look at 3 methods of estimating sales required to make a target profit. They are, as shown in the previous slide, equation approach, contribution margin approach, contribution margin ratio approach. Using their equation approach, we express operating income in an equation form, which is net sales revenue less total cost equals operating income. We can further break down total costs into its components, variable costs and fixed costs. Suppose Smart Touch Learning sells tablets for $500 each. Variable costs are $275 each, and fixed costs are $12,000 per month. If the company desires to earn $6,000 in profit each month, how many tablets must it sell? We can answer that question by using the equation approach. If we use Smart Touch Learning's information in the equation, sales revenue equals the unit sales price, $500 per tablet, multiplied by the number of units sold. Variable costs equal variable cost per unit of $275 times the number of units sold. Solving for the number of we determined that Smart Touch Learning must sell 80 tablets per month in order to earn a monthly operating income of $6,000. We can check our result by using the equation. In checking our calculation, we confirm that sales of 80 tablets per month result in operating income of $6,000 per month. Expressed in dollars, the company must have total sales of $40,000, which is 80 tablets times $500 per tablet. The contribution margin approach is a shortcut method of computing the required sales. Notice in the previous example that the fixed costs plus the target profit was divided by the contribution margin per unit. Therefore, we can use this formula instead. If we use Smart Touch Learning's data in this formula, we obtain of 80 tablets per month. Previously, we proved our answer using the equation approach. We can also prove our answer using the contribution margin income statement format. As you can see, a contribution format income statement prepared for sales volume of 80 units results in operating income of $6,000. Companies can use the contribution margin ratio approach to compute required sales in terms of sales dollars rather than in units. The formula is the same as using the contribution margin approach, except that the denominator is the contribution margin ratio rather than the contribution margin per unit. Computed the contribution margin ratio for Smart Touch Learning as 45%. Substituting Smart Touch's information into the formula, we find that monthly sales must be $40,000. Variation of the target profit calculation is called the break-even point calculation. The break-even point is the sales level at which the company does not earn a profit or loss, but has an operating income of $0. It is the point at which total revenues equals total costs. The same three approaches can be used. The only difference is that the target profit is $0. Exhibit 21.6 shows the calculation of the break-even point for Smart Touch Learning using the three approaches. Using the equation approach and substituting Smart Touch Learning's information into the equation, we see that the company must sell 54 units per month in order to break even. Note that the actual result is 53.333, but we must round up to the next full unit as it is not possible to sell partial tablets. The contribution margin approach is a shortcut method that produces the same result as the equation method, or 54 units. Contribution margin ratio approach, we see that monthly sales of $26,667 are needed to break even. This amount has been rounded up to the next full dollar from the actual result. Exhibit 21.7 shows a cost volume profit graph. This graph provides a picture that shows how changes in the levels of sales will affect profits. As in the variable, fixed, and mixed cost graphs of exhibits 21.1, 21.2, and 21.4, the volume of units is on the horizontal axis and dollars are on the vertical axis. To graph the cost volume profit relations for Smart Touch Learning, we draw the sales revenue line, the fixed cost line, and the total cost line. Then identify the break-even point. The break-even point is where the sales revenue line intersects the total cost line. This is where revenue exactly equals total costs. In this case, it is at 54 tablets or $26,667 in sales. based on the rounded figures we saw in Exhibit 21.6. Finally, we mark the operating loss area and operating income area on the graph. To the left of the break-even point, total costs exceed sales revenue, leading to an operating loss indicated by the orange zone. To the right of the break-even point, the business earns a profit because sales revenue exceeds total costs, as shown by the green zone. Graphs like Exhibit 21.7 are helpful to managers because the managers can use the graphs to prepare a quick estimate of the profit or loss earned at different levels of sales. The three target profit formulas are also useful, but they only indicate income or loss for a single sales amount. For this triad, a furniture manufacturer specializes in wood tables. The tables sell for $100 and incur $40 in variable costs. The company has $6,000 in fixed costs per month. The company desires to earn an operating profit of $12,000 per month. Number 10, using that information, calculate the required sales in units to earn the target profit using the equation method. So we have net sales revenue minus variable costs minus fixed costs equals target profit. Plug it in, go all the way down with that equation, and we get to 300 units. For number 11, calculate the required sales in units to earn the target profit using the contribution margin method. Well, for that one, again, we use the equation required sales in units equals fixed costs plus target profit divided by contribution margin per unit. So we have required sales equals 6,000 plus 12,000, all of that divided by 100 minus 40, or 60. So we have 18,000 divided by 6, 300 units again. 12. Calculate the required sales in dollars to earn the target profit using the contribution margin ratio method. Well, we take the contribution margin ratio, which is the $60 per table, divided by the $100 per table, which equals 60%. And then we plug that in to the required sales in dollars equals fixed cost plus target profit divided by contribution margin ratio equation. Plugs out to 18,000 divided by 60%, or $30,000. Number 13, calculate the required sales in units to break even using the contribution margin method. So, required sales in units equals fixed cost plus target profit divided by contribution margin per unit. That leaves us with $6,000 plus 0, which is the target profit, divided by $60 per unit. And that finishes out with 100 units. Managers often want to predict how changes in sales price, costs, or volume affect their profits. Managers can use cost-volume-profit relationships to conduct sensitivity analysis. Sensitivity analysis is a what-if technique that estimates profit or loss results if selling price, cost, volume, or underlying assumptions change. Let's continue with our Smart Touch learning example. Suppose Smart Touch lowers its price to $475 per tablet. The variable cost per tablet and the fixed cost do not change. We will use the contribution margin approach to determine the new break-even point. With the original $500 sales price, Smart Touch Learning's break-even point was 54 tablets. With the new lower sales price of $475 per tablet, the break-even point increases to 60 tablets. The lower sales price means that each tablet contributes less towards fixed costs, so the company must sell more tablets to break even. Return to Smart Touch Learning's original data, disregarding the change made in sales price in the recent previous example. Assume that one of the company's suppliers raises prices, which increases the variable cost for each tablet to $285 instead of the original $275. Smart Touch Learning decides it cannot pass the increases on to its customers, so the company holds the price at the original $500 per tablet. Fixed costs remain at $12,000. How many tablets must Smart Touch Learning sell to break even after the supplier raises prices? Higher variable cost per tablet reduced Smart Touch Learning's per unit contribution margin from $225 per tablet to $215 per tablet. As a result, the company must sell more tablets to break even, 56 rather than the original 54. Of course, a decrease in variable costs would have the opposite effect. Lower variable costs increase the contribution margin on each tablet and therefore lower the break-even point. Return to Smart Touch Learning's original data, disregarding the changes made in the previous two examples. The company is considering spending an additional $3,000 on website banner ads. This would increase fixed costs from $12,000 to $15,000. If the tablets are sold at the original price of $500 each and variable costs remain at $275 per tablet, what is the new break-even point? Higher fixed costs increase the total contribution margin required to break even. In this case, increasing the fixed costs from $12,000 to $15,000 increases the break-even point to 67 tablets from the original 54. Exhibit 21H shows how all of these changes affect the contribution margin per unit and the break-even point. For this triad, a furniture manufacturer specializes in wood tables. The tables sell for $100 and incur $40 in variable costs. The company has $6,000 in fixed costs per month. Calculate the break-even point in units under each independent scenario. Variable costs increase by $10 per unit. This shows you the way that increase affects all components of this calculation. And down there at the bottom, you see that we end up with 120 units. Now, what if fixed costs decrease by $600? Again, we see the effect that a decrease in fixed costs will have on the break-even point. As fixed costs decrease, we require fewer units to recoup the costs that are fixed. Sales price increased by 10%. Well, obviously, an increase in sales price will increase the contribution margin per unit. That therefore, the number of units required to break even goes down. And as you saw in this example, similar to one we looked at before, the 86 units is not a whole number. It's rounded up to that, but remember, we don't, in this business at least, cannot sell partial units. We've learned how cost volume profit analysis can be used for estimating target profits and break-even points, as well as sensitivity analysis. Let's look at 3 more applications of this analysis. The margin of safety is the excess of expected sales over break-even sales. Therefore, it is the amount sales can decrease before the company incurs an operating loss. It is the cushion between profit and loss. Managers use the margin of safety to evaluate the risk of both their current operations and their plans for the future. We can calculate the margin of safety in units, in dollars, or as a ratio. Let's begin by calculating the margin of safety in units for Smart Touch Learning. The margin of safety in units is 46 tablets. This means that sales can drop by 46 tablets before Smart Touch Learning incurs loss. The margin of safety can also be expressed in dollars by multiplying the margin of safety in units by the selling price per unit. The margin of safety in dollars in this case is $23,000. This means that sales can drop by $23,000 before Smart Touch Learning incurs loss. Finally, the margin of safety can be expressed as a ratio. The margin of safety in units divided by expected sales in units. Smart Touch Learning's margin of safety is 46% of total expected sales. In other words, the company can lose almost half of its business before incurring an operating loss. The cost structure of a company is the proportion of fixed costs to variable costs. This relationship is important because depending on the cost structure, small changes in the business environment could have a substantial impact on profits. Companies with higher fixed costs are at greater risk, but they also have the opportunity for greater rewards. Let's compare two companies to see how their cost structures affect their profits when there is a change in sales volume. Two companies provide horse-drawn carriage tours in Charleston, South Carolina. This is a very competitive business, and both companies charge $25 per person for the tours. Both companies expect to provide tours to 500 passengers during the month of December. The expected contribution margin income statements are shown for the two companies. Company A has low variable costs. Company B has the opposite cost structure with high variable costs and low fixed costs. During September, a hurricane threatened the area and many tourists made other travel plans. Both companies had only had 400 passengers during the month. The actual income statements are shown with this decrease in volume. Note that both companies experienced the same decrease in sales volume, but Company B's operating income did not decrease as much as Company A's because of its cost structure. Companies can predict the expected change in operating income due to a change in sales volume based on their cost structure. Operating leverage predicts the effects fixed costs have on changes in operating income when sales volume changes by dividing contribution margin by operating income. The degree of operating leverage can be measured by dividing the contribution margin by the operating income. Let's calculate the degree of operating leverage of both companies at the 500 passenger volume. The degree of operating leverage for Company A is 2.50. This means that the percentage change in operating income will be 2.50 times the percentage change in sales. For Company B, the percentage change in sales will have a lesser effect on the operating income at 1.25 times the change. This chart shows that the degree of operating leverage can accurately predict the effect on operating income when sales volume changes. The percent change in sales multiplied by the degree of operating leverage gives us the percent change in net operating income. Company A's 20% decrease in sales results in a 50% decrease in net operating income. Company B's 20% decrease in sales results in a 25% decrease in net operating income. We can check these results by comparing the estimated net operating income and the actual net operating and calculating the percent decrease. As you can see, we obtain the same result as using the degree of operating leverage. Notice that Company A had higher fixed costs and therefore had a greater decrease in profits when sales decreased. Higher fixed costs create greater risk for the company. When there is a decrease in sales, there is also a decrease in contribution margin to cover the fixed costs and provide operating income. However, a cost structure with high fixed costs has the opposite effect when sales increase. A 20% increase in sales would have had a 2.50 times that effect, or a 50% increase in operating income. Therefore, a sales increase of 20% would have resulted in an increase in operating income of 50%. Most companies sell more than one product. To calculate the break-even point for each product, we must compute the weighted average contribution margin of all the company's products. We'll use Cool Cat Furniture as an example. Cool Cat Furniture sells both cat beds and scratching posts, with a sales mix of 6,000 beds with 4,000 posts. The sales mix provides the weights that make up total product sales. The weights equal 100% total product sales. Sales mix or product mix is the combination of products that make up total sales. Cool Cat Furniture has a sales mix of 60% cat beds and 40% scratching posts. You could also convert this to the least common ratio, as 6 out of 10 is the same as 3 out of 5 cat beds, and 4 out of 10 is the same as 2 out of 5 scratching posts. So we say the sales mix or product mix is 3 to 2. Or for every 3 cat beds, Cool Cat expects to sell 2 scratching posts. To compute break-even sales in units for both products, Cool Cat completes the following 3 steps. Step 1 is to calculate the weighted average contribution margin per unit. To do this, compute the unit contribution margin for each product, and then multiplied by the contribution margins for the cat beds and scratching posts are added together for a total of $200. Next, this $200 is divided by 5 for a weighted average contribution margin of $40. Step 2 is to calculate the break-even point in units for the package of products. To do this, we use the same break-even formula we've used before, but dividing by the weighted average contribution margin instead of the contribution margin per unit. The result is a break-even point of 1,000 units. Step 3 is to calculate the break-even point in units for each product. To do this, we must multiply the package break-even point in units by each product's proportion of the sales mix. For Cool Cat furniture to break even, it must sell 600 cat beds and 400 cat scratching posts. At that sales volume, the company's total sales revenue would be $66,400. We can prove this break-even point by preparing a contribution margin income statement. If the sales mix changes, then Cool Cat can repeat this analysis using new sales mix information to find the break-even points for each product. In addition to finding the break-even point, Cool Cat can also estimate the sales needed to generate a certain level of operating profit. Suppose Cool Cat would like to earn operating income of $20,000. How many units of each product must Cool Cat now sell? We already know the sales mix, so we can move directly to step 2. The result is 1,500 items. Step 3 is the same process as used for the break-even point. We need to multiply the package required sales in units by each product's proportion of the sales mix. In order to earn a net operating income of $20,000, Cool Cat Furniture must sell 900 cat beds and 600 scratching posts. We can prove this planned profit level by preparing a contribution margin income statement. For this, try it, a furniture manufacturer specializes in wood tables. The tables sell for $100 and incur $40 in variable costs. The company has $6,000 in fixed costs per month. Expected sales are 200 tables per month. 17. Calculate the margin of safety in units for those previous numbers. So we have break-even sales in units of 100 units and margin of safety in units as 100 tables. Determine the degree of operating leverage. Plug it in. We end up with operating leverage ratio of 12,000 to 6,000 or 2 to 1, which is the same as saying 2.00. Number 19, the company begins manufacturing wood chairs to match the tables. Chairs sell for $50 each and have variable costs of $30. The new production process increases fixed costs to $7,000 per month. The expected sales mix is 1 table for every 4 chairs. Calculate the break-even point. Step 1, calculate the weighted average contribution margin per unit. We see here that it's $28. Step 2, calculate the break-even point in units for the package of products. We see here that it's 250 items. Step 3, calculate the break-even points in units for each product. Multiply the package break-even point in units by each product's proportion of the sales mix. Break-even sales of tables, 250 times 1/5 equals 50 tables. Break-even sales of chairs, 250 times 4 out of 5 or 0.80 equals 200 chairs. We'll stop here. So generally for the appendices, And for this appendix especially, we won't get into that. If you are an accounting major or plan to be, it probably would be wise for you to at least read over the stuff in the appendix, but we will not cover it in class.